Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, picture this. You've just wrapped up your latest Q4 forecast. Inside the company, things are looking pretty good. Sales are up, there's a good buzz. But then you look outside and the economic signals are, well, they're starting to flash yellow, maybe even red. Consumer confidence is slipping a bit.
Right.
Unemployment's ticking up, maybe just slightly. And you hear whispers the Fed might hike rates again. Suddenly that optimism feels a little shaky.
Yeah, that knot in your stomach feeling. We've all been there.
Exactly. So what's your next move? How do you make those big strategic calls when your internal picture looks rosy, but the external signs are worrying?
Well, welcome to the deep dive. That's exactly what we're digging into today, how to really understand and, more importantly, use economic indicators.
Okay.
Leverage them to make your planning, your forecasting, your big decisions just better. Because those fancy financial models you build, they don't operate in a bubble.
Right. They're grounded in reality, or they should be.
Precisely. Things like inflation, GDP, interest rates, jobs data, they're constantly pushing and pulling on those models. They influence everything, from your cost to capital right up to those crucial boardroom chats.
And that's really our mission for this deep dive, isn't it? We're going to go through the sources we've looked at on economic indicators, pull out the really key stuff, give you that shortcut to being genuinely well-informed, and maybe uncover a few surprising things along the way, help turn that stomach knot into actual strategic thinking.
Exactly. Foresight, not just anxiety. So at their core, what are these indicators? Really, they're just data points. Think of them as a pulse check on the economy's overall health, its direction.
An early warning system, kind of.
Yeah, an essential early warning system for anyone in finance or strategy. Helps you spot trends, anticipate shifts, hopefully before they whack your P&L.
Okay, so let's break them down. What are the main ones we should be tracking? And maybe go beyond just the textbook definition. Let's start with the big one, GDP, gross domestic product.
Right, everyone's heard of GDP. Total economic output of a country.
And growth is generally good, right? Signals
Yeah.
demand, confidence.
Generally, yes.
Yeah.
But the deeper dive, the real insight, is understanding what's driving that growth. Is it, sustainable investment, innovation? Or is it maybe fueled by consumer debt that might not last?
Ah, okay, so the quality of the growth matters.
Absolutely. Discerning that is key. Then you've got inflation, usually tracked by CPI for consumers, PPI for businesses.
And that obviously hits costs, wages.
It does. But a really critical insight here is how inflation expectations work. They can become almost self-fulfilling. If people expect prices and wages to rise, they act accordingly, even before the official numbers confirm it.
That's a really subtle but powerful point. Okay, what about interest rates? They seem to be constantly in the headlines. Fed funds rate, 10-year Treasury. How does a company actually connect that macro stuff to their, day-to-day?
Well, that's where it gets practical. It's not just about, say, the cost of borrowing for new factory. Think about the 10-year yield. A shift there directly impacts how you value existing assets, maybe even potential M&A targets.
Because it changes the discount rate?
Exactly. It influences your WACC, your weighted average cost of capital, which is fundamental to valuing projects, even the whole company.
Got it. Okay, and the last big one you mentioned, employment data. Unemployment rate, non-farm payrolls.
Right. Tells us about the strength of the labor market and, critically, consumer spending power. More jobs usually means more spending.
But is there more to it than just the headline unemployment number?
Oh, definitely. Some economists argue you need to look deeper, like at labor force participation. Are people dropping out of the workforce? That has long-term implications for wage growth, productivity. It's not just about who's currently jobless.
Wow, okay. It really makes you stop and think how interconnected all this is.
It truly is. That's what's fascinating. These aren't just separate numbers on a dashboard. They ripple through everything you do financially.
Yeah.
Your revenue assumptions, your SG&A forecasts, right down to those DCF models. They're all sensitive to these external forces, sometimes in ways you don't immediately expect.
Okay, so we get what they are now and some of the nuances, but the real trick, like you said, is seeing how companies turn these signals into actual action. Move from that stomach knot to a strategic advantage.
Right.
This is where it gets really interesting for me. What are some real-world examples? How do companies actually use this stuff?
Well, let's take Target. Remember the inflation surge in 2022?
Oh, yeah. Hard to forget.
Their finance team didn't just sit back. They were proactive. They looked at the CPI trends and adjusted their pricing. They rethought timing for promotions. They built rolling forecasts that specifically modeled different inflation scenarios.
So they were planning for consumers to pull back rather than just waiting for it to happen in their sales numbers.
Exactly, they anticipated it. Or think about a big industrial player like Caterpillar. They watch global GDP growth like a hawk. For them, it's a direct proxy for infrastructure demand. So if they see forecasts for slower GDP in, say, emerging markets,
That immediately impacts their plans.
directly, it flows right into their CapEx planning, their sales projections. It's not just background noise. It's a core input for their major investment decisions.
That's a really clear link.
Yeah.
And you mentioned airlines too, like Delta.
Yeah, think about periods of major stress like the start of the pandemic.
Yeah.
Delta's treasury team was using forecasts for unemployment, for oil prices, to run different scenarios.
Okay.
And based on those warning signs, they moved quickly.
Yeah.
They raised extra liquidity, they hedged their fuel costs more aggressively, they built out worst-case cash flow models. It was all about anticipating, getting ahead of the storm, not just reacting when it hit.
That really underscores the value of foresight.
Absolutely. And this raises that important question. How do companies actually build this anticipation into their everyday rhythm? It's not just the giants. You see Apple tracking currency swings and global inflation really closely for their pricing and supply chain. Walmart's FP&A teams use regional CPI data to fine-tune local pricing and even wage budgets.
So it gets quite granular.
It can. And think about Tesla. They're super sensitive to interest rates because it affects car financing costs and also government incentives, both here and abroad.
Okay, so that's the million-dollar question then, isn't it? We see how the big players do it, but how do you, listening right now, actually operationalize this? How do you get these powerful insights into your models to deal with that challenge we started with, those conflicting signals?
Right. Let's unpack a practical framework, something finance and strategy teams can actually use.
Okay, let's do it.
First step, build macro scenarios. Don't just rely on your internal base case. Use published economic forecasts, the IMF's GDP outlook, central bank rate projections, stuff like that.
Okay.
Use those as drivers to model different outcomes. Best case, base case, and importantly, a downside scenario. What happens if things go south? This gives you a range, a set of possibilities.
So you're stress testing your plan against external possibilities.
Exactly. Second, you need to directly link those indicators to your core assumptions in your model. Don't leave it vague.
How do you mean?
Like, let your inflation forecast directly drive your assumptions about wage growth and your cost of the goods sold. Plug interest rate forecasts into your WACC calculation or your debt repayment schedules. Connect unemployment trends to demand-side risk in your revenue forecasts.
So you're making the connection explicit and quantifiable.
Precisely. It makes the whole thing more robust and defensible. And third, monitor this stuff regularly. Create a macro dashboard.
Okay.
Pull data from reliable sources. FRD is great, the Fed's economic database, BLS for labor stats, maybe global sources like the IMF or World Bank, depending on your business.
And look at it how often?
Monthly, ideally. Review it alongside your regular forecast updates or when you hit certain reforecast triggers. It needs to be part of the ongoing cycle, not just a once-a-year thing during budget season.
So it becomes a continuous feedback loop?
Yes. And underpinning all of this, one absolutely critical practice. Document your assumptions rigorously.
Why is that so important?
Because when leadership, or the board, asks why you revised the sales forecast down by 3%, being able to point to specifics, we saw a significant drop in consumer confidence impacting our sector, leading us to adjust our demand forecast here and here.
Yeah.
That is so much more credible.
Right. Rather than just saying, things felt a bit soft.
Exactly. It adds weight. It shows strategic thinking, not just gut feel. It builds trust in your numbers and your analysis.
Okay, that makes a lot of sense. So maybe we can boil this down. If you're listening and want to use indicators like a pro, what's a quick mental checklist?
Good idea. Let's try one.
Okay, first, are your internal assumptions the ones baked into your plan being actively challenged by this external data, or are they just rolling forward?
Good one. Second, are those economic drivers like inflation or interest rates directly tied into the mechanics of your forecast? Is inflation hitting expense lines? Are rates affecting CapEx decisions in the model?
Right. Third, are you actually modeling scenarios that reflect these macro risks? Not just tweaking internal operational stuff, but really considering external shock.
Crucial. Fourth, is your team tracking these economic trends frequently, like monthly, or is it just an annual exercise?
Okay. And maybe fifth, when you present forecasts, especially to executives or the board, are you including this macro context, explaining the why behind the numbers based on the external environment?
That's a great checklist.
Yeah.
Because at the end of the day, financial models that ignore this broader context, well, they might look neat and tidy.
Yeah, clean spreadsheet.
Right, but they're ultimately incomplete. They're missing a huge piece of the puzzle, often the piece that can really make or break your strategy, especially when things get volatile.
Well, hopefully this deep dive has given everyone listening some practical ways to understand and actually use these external forces that are always shaping our financial reality.
I think getting a handle on economic indicators is a really significant way for finance and strategy professionals to level up. It moves you beyond just, closing the books or updating the spreadsheet.
Yes, more strategic.
It is. It's about adding that crucial context, adding credibility,
Right.
especially when the market's choppy. It helps you model better, plan smarter, and communicate with way more authority and foresight.
So maybe the final thought for everyone listening is this. As you keep building your plans, your strategies, your forecasts, how will you make sure you're not just looking inward at your own data? How will you stay genuinely tuned into the macro, ready to anticipate that next big economic shift?
That's the key question to keep asking.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.